Students, we will discuss about some of the concepts in terms of international investment appraisal. When you look at my webinar series on investment appraisal, right, that was done some time back, investment appraisal webinar, you would see there is a concepts and the techniques and all that we discuss in investment appraisal webinar, and the latter part you will see the how to evaluate the international investment appraisal. So that we looked at. So today what I am going to talk about is what are the things, what are the concepts relevant in terms of this area. So the financial number related or the way of evaluation we talked about it in the webinar under investment appraisal. Today we are going to look at the what are the other areas you should know under international investment appraisal. So moving there, you can see that generally when you say international investments, international, why invest overseas? Why the company go for overseas investments? There are 5 C's, they are given in the table. You can see that these are the reasons you would be moving out of Sri Lanka or any part of the world. When you are in your domestic country, you move to another country for business. Why? So you can see that one is that your company getting bigger, you want to become a larger company. Second, the company wants to have high quality supplies and cheaper labor, all that by shifting the country. Maybe in Sri Lanka your cost of production or labor cost is very expensive compared to maybe another part of the world. So you move there to do that production. So when you move that production, you have a cheaper item. So you would have seen that there are certain assets or certain equipments, certain products are manufactured not in the respective country. Right? If you take the certain products, you will see that the vehicles, now say the Toyota vehicles, it's no need to be manufacturing in Japan, right? Your Japanese vehicle must be coming. It's a vehicle brand is Toyota, but it comes from another country. So similarly, even any products you take, even a Nokia phone or maybe your Samsung phone or Apple phone, you don't need to be manufacturing in the respective country. It is you are producing that products in another country. Why that's happening? One of the reason is that your cost of import, cost of labor or cost of production is cheaper in the respective countries. Then the customer, you would like to produce your goods near to your customer. You may have seen that certain countries who are branded manufacturers, who shift their production facilities to elsewhere. Not only for their cost of supplies to be cheaper or labor production cheaper, it's because the customers are close to that. For example, you would have seen in India there are many factories, right? Many companies have come and Hyundai and other companies have come and put factories there because they know their customer base is there already. So they can put a joint venture and manufacture their products in that country so that you can sell it immediately to customer there itself. Rather than you manufacture in another country, export to that respective country. Because if you look at the population of the world, you know that China and India plays a bigger role in the total number. So you would like to be close to one of these markets so that your production can be reaching more customers faster. Then the competition, right? In order to avoid competition, sometimes your market is so competitive to sell certain products. But when you say the other markets, you see there is no much competition. Maybe that products are very new to that market. So you go and do that product. So maybe you go to African part of the world, or maybe you go to the Middle Eastern, or maybe you are going to the Asian other countries. So you move, like there are people moving the garment factory into Bangladesh. Like there are various paint manufacturers gone into Bangladesh. So they are going to different market. Even you would have seen this power projects. There are companies which are doing power projects not only in Sri Lanka, elsewhere in the world. So they go to different markets because they understand that you are able to make what you call the abnormal profits. So if you want to generate more profits, you can move into different markets. So even Sri Lankan company, you know, that Aiken Spence, John Keels, all these companies go out, like Damro, right? Garment factories are there for Brandix. They have different market, different factories in different places. hotels, they have certain people having hotels. So you move into different area or different country where you can make more money from those countries compared to your products or businesses in Sri Lanka. So this is basically the reasons why you are shifting to different country. And there is another reason, the currency. Currency is another reason which can be the investments can be matched with your cash flow what you can generate, so that your exchange rate risk can be minimized. Exchange rate risk can be minimized. And today, especially today's context, we all know that we are having or facing many issues with the dollar reserves are not sufficient, right? So we are trying to manage the dollar reserves as a country. So there are a lot of imports have been restricted, right, as you know, right, and then government is pushing more and more exports to be done, because we have very negative things because of the tourism was disturbed severely, and then certain exports have come down comparatively. So you are trying to fight out to keep the dollars that you have reserves, right? $4 billion reserves we have. So we are trying to manage that reserves, and with that we have more loan repayments, debt payments we have to make to the other countries. So this competitive or maybe challenging situation, you might see that my investment to be better that I have the investment in another country where I generate the cash flow in foreign currency and pay my repayment of the loan, rather than I generate the money here and pay the foreign currency loans. So this also could be looked at by various people. So why you at overseas go for overseas, these are the reasons. FDI, as you know that in Sri Lanka the FDIs have been affected last year with the COVID, right? So this year also to some extent. So we all know that globally because of the COVID there are a lot of issues people face. So the FDIs do not travel the way it used to be because of the crisis or the challenges faced in the world economies. But FDIs is where you get more funds to this country for the investment purposes. It can be outward or inward. So you are talking about Sri Lanka, generally we look forward to receive money as investments, because we all know that by getting investments we are able to generate more work, that means more production, more employment and more business activities, right? Apart from our foreign currency also will be generated, because we can do that manufacturing in Sri Lanka. If FDI comes, there will be more factories, some production will start, then the income will be generated, most of the time it can be exported. So we have an opportunity of generating foreign currency. So there are various reasons why the FDIs are promoted. Not only, I think the port city is a good example. Government is planning a very large scale dollar investment to Sri Lanka, or foreign currency investment to Sri Lanka through port city. So every investor, whoever wants to invest, whether it's Sri Lankan or foreigner, has to invest in foreign currency. So the foreign currency cash flow comes into the country. Apart from that, development takes place, job opportunities takes place, and more business activities, and we become very what I would say, like there's development in the overall context. So we have to understand FDI is something encouraged by government continuously. BOI takes the key or lead role in promoting FDIs to country in Sri Lanka. So it had got affected obviously because of the COVID last 1.5 years, but we are expecting a lot of things from this FDIs. I think one of the port city thing is a main one at the moment. Government is planning for the FDIs. Then you see that there are reasons why the countries go for investment in backward or forward. That is where you want to get your supply, your raw material supply, so that you would like to put up a company in a nearby region. Maybe say you want to put up a factory in Bangladesh. So you might do some production and send your raw material to Sri Lanka to do a finished goods here. So it can be one way of integration, right? Under mergers acquisition we talked about backward integration, forward integration, same concept. You can get that supplier to supply you, that is your company, or you can have a distribution company in the other part of the world where you manufacture and send it to that country. They sell the products from their neighborhoods to their neighborhoods. So that is our another forward integration. So you can see that one is the distribution side, other side is supply side. So it depends on what you need. You can have a company in another country which is supplying you or you can have a company where you supply them. So it can be backward or forward integration. So the forms of overseas operation, if you take the study pack, you look at it 1.2, forms of our overseas operations, there are 3 they have just mentioned. One is you start a subsidiary on your own. Right, if you are going and starting a subsidiary, you say, okay, you want to put up a factory in Bangladesh, you start a new company. You start a new company, from the scratch you do everything. That is one way of doing it. That is your own subsidiary company. Second, you can take over or merge with a local company already there. You can take over or merge with a company already there. By doing it, you will realize that you are able to get the information, market share, distribution channels, the brand, lot of things already established there. You go and buy that. So there is an advantage of you getting into that country market faster than you can do it from the own subsidiary when you start. So please be aware of the difference. When you start your own, you put everything, you start from scratch. That means you may fail, may not fail. Second one is where you already have a company there. Somebody is doing that company, already is doing business, he has a brand name, he has products sold in the market, there are staff working for the company, distribution channels are established, lot of things. When you go and buy that company, you start from there. Okay, maybe you have to pay a higher premium to buy the company, but you are already having a established company, so go forward. Third, a joint venture. You will go with a local partner in that country and start a joint venture. So he might say, okay, you have 50%, you have 50% or 40%, 60%, whatever number, you basically get hold of a local party to start a business. So there are countries where whether you like it or not, you have to go with a local partner. There has to be a local partner. Right? There are countries where they don't allow you 100% ownership in that country. Right? Then you have to start as a local joint venture company. As you know, the local joint venture company is generally it's a contractual arrangement where both parties agree to share profits and ownership at a percentage, and there will be terms and conditions on which you will do your business. Okay, that's basically the joint venture transaction. Then they mention the foreign subsidiaries. Why do you want to start a foreign subsidiary? That means you are a local company, you start a subsidiary company in another country. Why do you do that? 1.4.1, the purpose of setting up subsidiaries abroad. What is the purpose? One is the location of market. I think we earlier also talked about it. Right? Your location of markets, your market may be close to that country, so you better you have the company there so that it's easy to sell. The opportunity to produce goods more cheaply, very important. Maybe the Sri Lanka cost of production is expensive, so you move into another market, so another country, putting up a subsidiary company, your cost of labor is cheaper. Then need to avoid import controls. Sometimes the products, some things what we are going to do, it's costly. Now for Sri Lanka, if you are manufacturing, if you are importing vehicles in Sri Lanka, huge tax. Right, you are paying huge tax to government to import a vehicle. But same thing, assume one of the vehicle manufacturer in another part of the world try to put up a vehicle manufacturing plant here. Let's say Toyota or maybe Mitsubishi or maybe say Indian models, whatever vehicle company. Come and put a plant here, they produce that vehicle. Then automatically you are avoiding the huge duty aspect, tax, what you have to pay for importing vehicles. By doing that, your local production or local industry also develops, one. Second, you get more employment. Third, you will see that the price of the goods become cheaper compared to earlier prices, because earlier it is supposed to be expensive because your taxes are very high, and by doing this manufacturing you will see there is a cost reduction. It can be applied to many products. I am just taking Sri Lankan example, it can be any country. So when you go to that country and do that, you can avoid the import controls and the taxes. Need to obtain access to raw material. Sometimes your raw materials are very close to that. Some products you need to get your raw material faster. You need to keep it very short period and convert into next situation or next phase. So that may be a reason why you want to put a factory in that country. Then the tax concession or availability of grants, sometimes the government or in other parts of the world, countries will say that anybody who come and invest in our country, like Sri Lanka, we say the port city, people come and invest in Sri Lanka, you get more concessions, tax concessions are given. Why? We are promoting FDI, so people to come and invest. Same thing another country also do, then somebody come from Sri Lanka, go and put the subsidy there to make money out of it because they get tax concession or grants. So these are the reasons why the accepting subsidies abroad. Then how do you get your return from your investment? Generally the returns of the subsidiary company abroad are the dividend what you get, But sometimes the dividends alone may not be enough. So you will try to see whether sometimes you are buying goods from them or you are selling goods to them. So one of the way you will be making a margin out of it. That is a transfer pricing issue or the concern also there, but then you need to make sure that you are reasonably charged, so you get a profit transferred from one country to another. Then the royalty. Sometimes the brands, if you are using our brands in other part of the world, that you will charge royalty for the brand usage or patent usage. So because of our knowledge and expertise you share with the other part of the country, other part of the company, you are getting a royalty paid by the other company. So they will start calculating based on each unit they sold or produced, they will give you say X rupees for each unit produced. So that's basically royalty you get. Then if the company wants to give a loan or they give you a loan, based on interest rates available lower rates, you can transfer money here or the other and make money out of it. Then the transfer pricing is one of the concerns you might think of. Then how do you finance the overseas subsidies? Generally you will be using the respective subsidiary company cash flows. You can generate, from that you can manage your financing requirement. When you are going to invest, say for example you start a hotel in Maldives. So in order to invest in the hotel refurbishment or some capital expenditure, you need money. One way is to generate cash flow in that country and fund that. That is one. Or you can using the parent company home currency. The parent company will raise the money in Sri Lanka and send the money to say Maldives. Or you might say that the local company to raise the finance on their own. Local company raise the money on their own. That means they can borrow money in their respective banks. Local banks like Maldives, you take Maldives company, go to the Maldives bank and borrow money. Or Sri Lankan company borrow, it's a parent company, it's borrow in Sri Lanka, we send the money to foreign company. Now these things, the important aspect is the exchange rate. Exchange rate plays a bigger role. So if the exchange rate is changing significantly, you have to be very careful in deciding where you should borrow your money. The other aspect is interest rates. Sometimes it looks like cheaper to borrow in another country and send the money to other country. Right? So you need to look at those things carefully. I think under the foreign currency risk management we talked about this interest rate parity. If the markets are working perfectly, you can't get the interest rate arbitrage by borrowing in one country and transferring money to another country and gain out of it. If the interest rate and exchange rate markets are working perfectly, you can't make an interest rate arbitrage significantly. So you need to understand that the interest rate parity theory what we learned under foreign currency risk management has to be considered in deciding whether I should borrow money in Sri Lanka or elsewhere. The other aspect is, even though sometimes you borrow money in Sri Lanka, you may not be able to send the money to Maldives. Like today's context, the exchange control regulations are very strict today because the dollars are not sufficient in the country. So the government doesn't want the dollars to be just transferred as it is faster. So they are having controls. So in that kind of situation, if I want to say $1 million I borrow here and send it to Maldives, I can't do that. So the government will not allow that. So you have to be careful when you are sending money out. Then risk of overseas investments. I think here very important, because most of the time all these foreign investment when you are going for any company in Sri Lanka is planning to invest abroad, they need to see what are risks involved in the going abroad. As we mentioned earlier, you can start your own subsidiary company, or you can go and get into ownership in a company which is already in business there, so you buy that company, or you might get into a joint venture operation where there will be another local party and you both together start a business. So there are various ways we can have business in that country. So what are risks involved when you are going abroad? Right, everyone says like, okay, we discussed at the beginning, what are reasons of going abroad? So we said one is that to reduce cost of production, getting the supplies faster, close to the supplier. Then we said we are close to the customer, the market is there, so I better go there and put the factory there. Customers are there. So that is third one. Fourth one, we said that to reduce the competition in your local context. You see that local context, we have huge competition, we can't fight here. So might as well we shift our production into that country or another country. So that country I go there and my competition is lower, so I can do more business. I said there are enough companies in Sri Lanka gone up outside Sri Lanka and they have done businesses and they are successfully doing business also. So you need to understand that garments are gone, hotel sector are gone, furniture businesses or paint businesses are gone. So these are companies already gone. Apart from the banking side, you will have a branch offices in respective countries. Those are not a very big operation, but you have. And I have to mention specifically LOLC had a bigger finance company in elsewhere, and they sold that investment, microfinance business, and sold that business and made huge money and brought to Sri Lanka. So you need to understand there are various companies have gone out of this country and they have successfully done it also. So we have to understand this is the maybe comparative to the total company since Sri Lanka, the amount of company which gone out of country and made businesses are very small. We have to accept that. But they have gone and been successful. There are maybe many businesses are in Sri Lanka only. They don't want to be in other country other than they export. They export goods, but they don't have a subsidiary or a joint venture or branch offices in those countries. You don't have that. They are mostly exporting companies, if at all. But there are few companies have gone there and done business. They are doing business also, like different sectors. So what I would like to say, when you say that you are going to move out, do you have risk? Do you have risk in going out of this country for business purpose? Truly speaking, there are a lot of risk. All that risk, you need to see it first. When you are going out of the country, we have to see the risk first. We have to list out the risk. And we need to decide, okay, how do I go to minimize this risk? Some of the risk cannot be eliminated. I have to accept that risk is available, but I can minimize. So what things to be done? So that has to be decided by me. So there are key risks in this study pack, we can look at it. One is foreign exchange rate risk. When you are talking about you are going and putting up a factory or business in another country, your exchange rate will be your determinant of your cash flows. Right? If you are going to depend on that cash flows to Sri Lanka every year, you need to understand the exchange rate will decide how much you are going to get. Even though you do good business, your cash flows, if the exchange rates significantly vary, you might be impacted by that. But Sri Lankan context, the exchange rate, you know that Sri Lanka rupee is depreciating for a longer period. More than appreciating is a longer period. So even if you say there can be slight like this, but if you look at it's like this. So you might say that it appreciated here, it appreciated here, appreciated here. These are appreciated times. But these are all depreciated times. So finally what you have seen, the exchange rate has gone like this. So $1 can be say 100 sometime back, Now $1 is equal to 200. So what had happened? This for whatever number of years, it has depreciated. And Sri Lanka at this moment, 6.7% depreciation for the year. Sri Lanka rupee depreciated 6.7% for the say 6.5 months. 6.5 months, we are talking about 6 point some percentage have been depreciated against the dollar. So this is what we have to understand. The rupee continue to depreciate, As an investor going abroad and you put your money, you are going to get cash flow from that country, you are going to make money. Why? Sri Lanka rupee depreciating and you are going to get the money in foreign currency. So when you are going to get money in foreign currency, your rupee depreciation will benefit you very much. So you are in a better wicket than you importing goods. So this is a very good situation where you export, or more than export, you have your own company in foreign country and make money out of it. So exchange rate risk in this scenario is beneficial. But assume that now we are going and start a subsidiary company today at 200 rupee dollar rate. And 1 year's time, due to the foreign FDI is coming to Sri Lanka with the port city and almost the COVID is finished and then tourists start booming, then the income start increasing in foreign currency. Then the rupee will appreciate. So the rupee will appreciate to say 185 level, not at 200 rupees. So 200 rupees become 185, then automatically you know that within the 1.5 years time, our investment which was made at 200 rupees, we are going to lose the value of the investment because the exchange rate is 185. So this is one side of the thinking. You can look at it as a risk from the foreign currency investment. Right? So please be aware, anyway your cash flows are working on exchange rate, because your cash flow what you generate from, if you are exporting or you say your subsidiary company going to send goods to you or you send goods to them, then every transaction is subject to the exchange rate risk. So this risk needs to be managed. I think under foreign currency risk management, we have discussed how to manage the risk, exchange rate risk, but please be aware that is one main risk in the foreign investments. Okay. Second, political risk and country risk. If you are going to another country for your business, you need to understand it's like somebody coming to our country. Somebody in another country is coming to Sri Lanka for business. So he is supposed to face or he has to understand the political issues in the country. So political risk is there. Same thing we have to understand when you are going to another country, say Maldives, we need to know what is the government there, how long the government is there, and what is the chance of that government changing in short period, and will there be political stability, and their policies will be stronger, they will be there for some time. But otherwise, when you do your feasibility study and the investment appraisal, you calculate your cash flows based on some expectation and assumptions, and you say tax rate going to be 20%, and interest rate going to be 10%, or inflation going to be 5%, and maybe your products pricing and all that, you will have assumptions based on that only your feasibility is done. After you go there and 1 year line, government says no, tax rate of the foreign companies is not 20%, 30%, or you cannot or you may have a restriction to say that your employees for a foreign company, ownership company, anybody who is working in that company should be paid 25% more salaries. 25% more salary than the market rates. So there can be restriction brought by those countries after the government changes. So political risk is there always. Political risk is there, especially where the government could change very short period, where it's not stable government, or their policies are not consistent. Their consistency is not there in the policies. So political risk and country risk is about those there. The country also, in addition to the political, the country itself can have certain other risk. Right? For example, a country where you see the war is happening or the fights are going on, some tension is there always, or maybe that the country is not financially strong country, it has its own weaknesses. So if the rating of the country is very low or poor rating. So those things can impact your business. Where you cannot be very concretely say this is my strategy, this is my cash flow, this is my profits going to be for the next 5 years, because those all can change overnight when that country situation changes. So those are the difficulties or risk you have in foreign investment. I am not saying that's not there in Sri Lanka, it's all there in Sri Lanka also. But when you are planning for complete investment in foreign country, these risks are there. So you need to be planning this. How do I minimize the risk? How do I reduce the impact of the risk? You have to get ready and strategies have to be implemented. Third, geographical separation. When you say I am going to put up a factory in, say, African part of the world, right, I am saying Ghana, I am going to put a factory, right, I am basically distancing myself from my company management and that company. Even though it is true that technologies have developed, we can do everything and anything under the technologies help, we can monitor those companies, all can be done, true, I am with you, but still there is a certain amount of management control is not available when you are distance yourself. Right? There is a difference between you doing technology based monitoring and you are physical monitoring. So you, and especially in a country like outside world, you go and put up a factory and you don't have your own people, even at least 2, 5, 10 people, if you don't have it, it's very difficult that you depend on that company 100%. But at the same time, there can be another school of thought where they will say anyway it's all based on delivery. So if they are producing and they are going to deliver the results what you want or KPIs what you have set, you don't have a problem whether they are in Sri Lanka or in any part of the world. But geographical separation has its own risk. So you need to see how best I can monitor. Sometimes you don't know, you don't have access. You don't have access to that country. Sometimes you can't go to that country. Suddenly the government now say the COVID, right, most of the country we can't travel, right, now there are restrictions, right, so that countries are facing the problem and then we have been, certain countries have red listed us, so you have problems in going to another parts of the world sometimes, so you need to be careful when you are deciding on your factories. Litigation risk. Any foreign investment when you go, you need to know the legal framework of that country very clearly. Labor laws and compliance of all the taxes and statutory requirements, there could be regulations of the country which you have to comply with when you are doing business in that country, especially as a foreigner. So labor laws have to be very clearly looked at because there are restrictions, you can't do what you can do, what you can't do, how you should treat people, there are a lot of things you have to look after. So rules, regulations have to be very clearly known to you. So the compliance of those is a one risk any foreign investment company has to look at. Same thing apply, anybody coming to Sri Lanka also should know that, because he can't just come and start a business here, within 1 month we will say no, you have not complied this, you have to pay this, you are penalized, you have to pay taxes or you have to pay penalties. Same thing which can happen to our companies going abroad if they don't know the local context requirements. The advantage of you going with a company, already you are running a company there with a local partner, then you have a better chance of managing it better because your compliance risk is almost done or complied by the local party. So you get the advantage of that knowledge, so you can manage your business. Then the risk of loss of goods in transit. There is one thing they say, it may be possible to lose your goods in the goods in transit. So if you are talking about I am sending goods to another part of the country, another part of the world, and that country is exporting goods to Sri Lanka, I will face that issues. I will face the issues of the goods getting lost. So that's basically one of the other risks you can think of. So these are some of the risks when you are going for foreign currency or foreign investment. So all of us has to understand that you going abroad for your business definitely have risk. Only thing, we have to find the risk management systems. What are the methods of risk management? How do I manage this kind of risk? I have to do all that, study properly and make sure that I am compliant with. Because otherwise you go in there, then after that you have put your, I am sure like it's billions of money, you can't lose that money at once. Right? So you have to be careful in your Then implication of international investment. Right, you need to understand that generally if you are investing locally, if you are requiring a return of say 15%, if you are investing in foreign country, you will require more than 15%. Why? Your risk is there. So your return requirement for foreign investment will be your return requirement for local investment plus say risk premium. Like what we talked about earlier, right? You will say government security I want 7%, but a corporate bond I will need 9%, 2% more. Same thing here, you can say risk for local return requirement for local investment. If the same garment factory I am opening in Sri Lanka, I would want a return of 15% per annum. But if I am going to do that in another part of the world, another country, I would say I would need another 5% more. So my return requirement is 20% per annum. 20% per annum. So please be aware that return requirement for investment has two components. That is your local return requirement plus your risk premium. For going abroad, whatever risk we talked about, you are looking at that from a return. As I get more returns, I am fine. So I can recover my investment faster, return faster. So this is how the return could be expected. Then there is the implication whenever we have a subsidiary company in foreign country, for our local consolidation purposes, we need to convert the foreign currency assets and liabilities and their transactions to Sri Lankan rupees. So we have to do that conversion at the foreign currency exchange rate. So when you do that, there will be an impact on our P&L as well as the balance sheet because of this conversion. That is called translation risk and exchange rate risk management we discussed. This is a translation risk. So these always there in the foreign currency investment or foreign investments. And the tax implication, generally your dividends or profits what you are going to get from that respective country will be subject to tax. Right, depends on the arrangement in Sri Lanka, what you call double tax treaty arrangement. That is what do you mean by that? If you say you have business in Singapore, so Singapore you have paid the taxes, and then after paying taxes you send the profit to Sri Lanka. So in Sri Lanka that profits will not be re-taxed because already it has been taxed. So that is dependent on your double tax treaty arrangement with the respective country. So Inland Revenue Department of Sri Lanka have signed, or the government of Sri Lanka has signed with respective countries double tax treaties where they have clearly mentioned what are the conditions, what are the exemptions, all that they have mentioned. So based on which your tax rate or tax liability will be decided. So not some countries you have to pay tax in that country and you have to pay tax in Sri Lanka. So both you have to pay taxes. Some countries you pay taxes in that country, when you come to Sri Lanka you basically get a tax credit for the tax what you have paid already. So like a withholding tax earlier system, withholding tax you pay and the recipient can claim it from the withholding tax what you have already paid. So you have an advantage, you don't pay duplicated tax. Okay. So profits will be liable. Then any income you are getting, it can be dividend income, it can be disposal of assets gains, all can be liable for tax, depends on your tax regimes of the respective countries and your double tax relief. The other important thing is in foreign currency investments or foreign investment is the remittance controls, the exchange control regulations. You can see 1.12, the overseas government may place restriction on remittances. Right, you will like to get your money transferred to Sri Lanka. Your company in the foreign country has made enough profits, so you can remit to Sri Lanka. But that country government may restrict. That country government may restrict that you cannot transfer 100% profit out of your country. You can only remit 60%. 40% of money you have to invest in the respective country. You can be having what you call limitation like that. So then the Sri Lankan company has to understand that you cannot bring the 100% profits to Sri Lanka. There are restrictions. So this is something very important. Due to this restriction, some companies could look at various ways in which they can get that return back to Sri Lanka. So how they can do? The list is given there. One, charge overseas subsidiary company additional head office overhead charges. So you might say that since Sri Lanka company is a holding company, they are doing certain work on behalf of the subsidiary company, they can charge overhead charges that saying that like a management fee, you will charge that from the respective subsidiary company. So even though the profits cannot be distributed 100%, you can charge this kind of thing. So that is one way you can do that. Then the subsidiary company can lend equivalent of the dividend to the present company, parent company. They can lend, they can give loan. Rather than paying dividend, they can lend the money to Sri Lanka. Third one, subsidiary company can make payment to parent company in the form of royalty. As I mentioned earlier, you can say that okay, every unit of production the company make, I should be given a royalty. So the royalty will come. Then increase the transfer prices paid by the subsidiary to parent company. That of course I would say it's subject to, because transfer pricing regulations of respective countries might fight you or find fault with you, but you may look at that option also. Overseas subsidiary company can lend money to the another subsidiary company funds in the same country. So if you have two companies in the foreign country, you can see that one company fund the other company. Rather than you sending money to Sri Lanka, you tell them can you give it to the other sister company there, so that they can do that business. So you would see that there are various ways, apart from you paying dividend to Sri Lanka, various ways in which you can transfer money from that country to Sri Lanka. So that Sri Lankan company will get their return in different forms. Right? If you say the investment, you can see that you might have investment in foreign company. So your return, you are expecting return from that foreign company. Why you have invested? For return. So the return can be one is profits or dividends. Second, as we mentioned, it could be your overhead charges. It can be called as management fees. Third, profit or dividend, overhead charges, second, or management fees. Then you might see that lending, they can lend money to Sri Lankan company. Then you can get royalty for sometimes. Then you can have your transfer pricing adjustment, that is when you say your sales or your cost of sales, that is you are importing goods or you are exporting goods. So one of the way you can get it. So you see that your return may not be coming only from the dividend from your investment. Your return can be coming from various ways. Return can coming from profit or dividends or dividend cash flows. Overhead charge or management fee you get annually. Then you get the lending by them, so that you get that benefit. Royalty, that is every year you can get royalty from them. Then the transfer pricing, export import, margin you can keep it. So there are various ways you can get your return. Why I am saying this important, when you go to your case study question, right, when you have a foreign currency or foreign investment, they might talk about one of these things. Right, they will be saying that evaluate the foreign currency investment from Sri Lankan company point of view. So you can't say Sri Lankan company point of view mean only profits you are going to get. Your investment not compared with profit only. Your investment can be compared with profit and all these items. So you have to consider all these as a part of the return or recovery of your investment and compare with your investment and see recoverable, not recoverable. So this is basically so when you see the international investments, I think under investment appraisal last part, I think we discussed about this evaluating method. I just touch upon again, right? When you say international investment or foreign investments, there are two approaches we can take. There are two approaches we can take in evaluation. Say for example, I have invested in Bangladesh. I can evaluate my investment or project by comparing my investment and my cash flow, what I generate from Bangladesh to Sri Lanka, cash flow derived to Sri Lanka. So if I take this first option, I have investment and compare with cash flow derived to Sri Lanka. I compare the investment and the cash flow derived to Sri Lanka. In this case, the cash flow derived to Sri Lanka, I basically have to calculate the profits of the Bangladesh. If I take the example of Bangladesh, the profits of Bangladesh in Bangladesh currency. I calculate the profits in Bangladesh currency, and annually I convert to Sri Lankan rupees the dividend cash flow. Annually I have to convert to Sri Lanka rupees dividend cash flow from the Bangladesh cash flows. That I compare with my investment. So what I am trying to do is, I am going to calculate my Bangladesh profits, that is in Bangladesh currency, and annually I convert to Sri Lankan rupee, whatever dividend amount what they are going to pay. That I compare with my investment by taking the present value calculation. So this is investment appraisal question. Present value you calculate. In the purpose of calculating present value, my required rate of return or cost of capital will be in Sri Lankan rupees. My Sri Lankan rupee, whatever requirement, my return requirement, I take that and discount the cash flows. I will say for 15%, because my rupee cash flow I am going to convert. So rupee cash flow I will discount. So that every year I get that Bangladesh profits in foreign currency and calculate to dividend cash flows and basically calculate the Sri Lankan rupee NPV. So this is one way of doing it. Okay. Second one, you will see that your Bangladesh profit or dividend cash flows in Bangladesh currency. Bangladesh profit and dividend cash flow in Bangladesh currency, and I compare the investment and the dividend cash flows, in Bangladesh currency, investment and dividend cash flow I take in Bangladesh currency, and discount at cost of capital or required rate of return in Bangladesh currency. So I will take the cost of capital in that country, say 6%, 7%, and evaluate that project. So I evaluate the entire thing in Bangladesh and calculate the NPV. That NPV I will multiply it by year 0 exchange rate and get Sri Lankan rupees NPV. So I take the Bangladesh profit, whatever revenue, sales, cost of sale, all that, Bangladesh project of profits and dividend cash flow in Bangladesh currency every year, annually. Then I take the investment what I have made in Bangladesh, I compare with the dividend cash flow what they make and calculate everything in Bangladesh currency and calculate the NPV. In order to get the NPV in Bangladesh currency, I discount at cost of capital or required rate of return in Bangladesh currency. Once I get the NPV, this is already in Bangladesh currency. I convert at year 0 exchange rate and get the Sri Lankan rupee NPV. This is the second way of doing it. So first one, we have done it by converting the cash flow every year by forecasted exchange rate. We have to forecast the exchange rate for each year with Sri Lanka rupee and Bangladesh currency and discount the entire cash flow to Sri Lanka every year and discount at the Sri Lanka exchange rate, Sri Lankan discounting rate or required rate of return. That is first one. Second option or approach, everything you do it in Bangladesh currency and get the NPV also Bangladesh currency. Only thing you have to clearly understand, the required rate of return or the cost of capital of the company will be in Bangladesh how much, not Sri Lanka rupee point of view, Bangladesh point of view. Get your NPV, convert at year 0 exchange rate, you get the Sri Lanka rupee NPV. This is the second approach. So there are two approaches we can be asked to evaluate the foreign investments. First approach is the most time you will be doing, not the second one. First one is the most of the time because we have to get the every year cash flows converted to the Sri Lankan rupee. Because the examiner would prefer to test your exchange rate risk management area also. So he will want you to apply your foreign exchange rate based on your parity theories or your forecasted rate and get your Sri Lankan rupee. And again your cost of capital is always cost of capital of Sri Lanka. So you have to use that to evaluate. So that most of the case study questions you will see the evaluation taking place in Sri Lanka. So the evaluation taking place in local currency. So the conversion has to take place every year and convert, first option, not the second one. But this is also possible. So that's basically you give you the idea about international investment appraisal theoretical framework, right? What are concepts, what are things possible, how can affect your organization, and what are risk aspects you have to consider when you are going for foreign currency. Because the examiner, especially when you are going to do a foreign environment company question or the case study, generally it's given in case study question. One part of the question they can ask you always is the risk involvement, risk management side of it. What are risks involved in especially in foreign currency investment? So generally we know that it is exchange rate, political. Actually one of the things which is not in the study pack is a market risk. You will see the demand, that's the market side or the demand is how it's going to work. Right? You might say that you have business in that country and you go there. So market risk, if you are not going to get enough demand for your products, you have a problem. Because there can be mindset in the people sometimes that your local products are better than the foreign products. So foreign products may not be able to sell easily. Or maybe your products have different nature of quality, so people may or may not like it. So there is a risk always in the demand. So that is also to be considered when you are going to that kind of market. Because you should have alternative arrangement. I think under real options we will look at, when you say that you have a problem in your market, you should have an idea how to get out of that market. Because you can't say that I will make losses and I have made 2 year losses and am I going to continue the losses for years and years. I better stop it. I have to decide where I should stop. Because generally the concern is that once you start the business, people think that we should not stop business. It's not like that. If you don't make money, especially when you are going abroad, local business, even though your returns are lower, you might stay with the company. But if you have foreign businesses, are you taking the trouble of continuing that business even at a loss? And you take almost everything under risk consideration, because you are not in your control of all the activities. So you will see that whether it's worth it to continue the business, so you decide. So under real options, it is there the option that where you realize that your project is not worthwhile, then you abandon the project. You abandon the project. At that time you have to say, no, I stop it now, get out of the business. I have to get out of the business. So this thinking has to be there in any business. So these are the things in foreign investments, foreign businesses, we have to be looking at it. So that's basically the chapter 8, right? So I would request all of you to look at the study pack more in detail, not only this chapter, even other chapters, because it is a good material. Good material. There are a lot of areas while reading or by reading on your own, you can understand better, right? Even though you don't follow classes, you may be able to get the study pack. If you really read it properly, you will get most of the knowledge, and you can do many practicing questions. There are questions given there. So please do that. Please do that, because that will help you. Because as I mentioned, there are various webinar series we have done on different topics, right? So you can search those things on the YouTube and make sure that all the areas are being covered, right? Thank you.